Good afternoon, ladies and gentlemen. Welcome to Option Trades Trading the Economics Calendar. We'll begin our webinar in just about 5 minutes as soon as everyone's had a chance to log in and get set up. So I'll be back with you shortly to get started. In the meantime, I would appreciate it very much if you could locate on your computer monitor the screen that lets you type in questions and answers and chat with me. And if you can just write in and let me know that you can hear this announcement all right, so I know your audio is working and my audio is working. Second, let me know what country you're visiting us from, and let me know if you're currently a trader with with Option Trader, or you're just a new trader to binary options, because that helps me know how to change the webinar to fulfill all the clients out there. So if you can write in those things, I greatly appreciate it, and we'll get started in just a few minutes. So sit back and relax, and I'll be back with you right on the hour. Good evening, ladies and gentlemen. This is Barry Norman from Option Trade. Welcome to our class on trading the economics calendar. Now, there is a couple things I have to do before we get the class started. And that, number one, is to give you our risk warning. Trading in binary options can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information that is provided in this webinar is for educational purposes only. The presenter, that's me, is not a financial or investment advisor, and we do not recommend any securities or instruments of any kind. All securities that we talk about tonight are cited only for educational purposes only. So in other words, when we review the next week's calendar and we talk about making trades and analyzing it, I'm trying to teach you how to do the analysis. So if I say you can trade the euro going up, that doesn't mean go trade it. It means do your own analysis, follow the steps that I teach you, and then make your own decision. And that's how you should trade at all times. Never guessing, doing your own analysis and making your own decision and making sure you understand how to trade and what the trade is that you're making. Now, we have to give you this risk warning because Option Trade is a legally registered and regulated binary options and investment company. And we are required to do certain things by the Securities and Exchange Commission, and that is number one, to give you a risk warning. Number two, to trade and make sure all of your transactions and everything we do with you is transparent, and not to give you a whole line of BS while we go along with it. So, on that note, I'm going to remind you when we trade binary options that we are only looking for a reason or something that we determine will give an asset momentum to carry it up or down at a specific period of time. Because remember, with binary options, you only are concerned with which direction the asset is going. Okay, not how far it's going to go, because you make the predetermined profit whether the euro goes from 133.99 to 134 or 134.50. It doesn't make a difference. You only get the predetermined profit. So we don't have to concern ourselves with how far the asset will go. Number one. Number two, we don't have to protect from loss or risk, because the only risk or loss we have is the dollar amount we type into the screen. So trading the economics counter is one of the best ways to trade binary options. Now, the economics counter is a fundamental analysis tool that allows traders to position themselves to take advantage of future currency movement. The economics counter, which is, it's not actually published, it's updated daily on almost immediately, and it's a key trading tool for traders to use fundamental analysis as signals for entering or exiting trades. Economic and political news can change the direction of a currency pair in seconds, and fundamentals that are true in an instant can be rendered absolutely meaningless by fresh fundamentals in a few seconds later. Okay. Now, the economics counter enables traders to track the economic indicators and political events that impact currency movement. So all that basically says is the economics counter tracks all economic events, puts them all together in one nice, easy place, so you don't have to start tracking down what's going to happen and miss an event or make a mistake trading because you don't realize something is due to happen, whether it's a speech by Mario Draghi or a decision by the Federal Reserve in the U.S. or it's Chinese data or a meeting by the G7 or the G8. All this is kept for you on the economics calendar. Now, the important news for trading the Forex market is programmed months in advance. Traders will know when a meeting of the European Central Bank to discuss interest rates will take place on such a date in the future. This gives traders time to do some research and some analysis and position themselves accordingly. Now, the key is, number one, knowing where to find economics, and they're free and easily available to everybody. The second is learning to read the economics calendar. From there, tonight we're going to first learn to read the economics calendar and how to interpret the data that is on there. And then from there, we're going to go try to build a strategy to trade these economic events. So first, I'm going to ask the people in the class if you could type in, do you understand how to read an economics calendar? If all of you know how to read an economics calendar, I don't need to go over it. If you don't, I'm going to go with you step by step and explain all of it. So if you can write in and say, yeah, I know how to read an economics calendar, I will skip this part. If I don't hear from you, I'm going to go forward. Okay, now, the first thing we need to look at on the economics calendar is the current time. Okay, no matter which calendar you use from which provider, and they're free, okay, you must adjust the calendar to your local time zone. You don't want to make a mistake and make a trade incorrectly because you miscalculated the time of an event. So all of them will give you either a drop-down menu or some type of a easy way to change the time of the events to your local time zone. And then you will see the time of the scheduled event down the left-hand side. And no matter which calendars you go to, and I've seen a lot of them, I can tell you over time I've seen one or two weird ones that are really not the standardized calendars where it's, some website just makes them up and takes data from somewhere else and puts them on there, and they put them in a screwy method. But almost every calendar is laid out the same. Okay, they start out with the time in the left-hand side. From there we go to the currency that will be affected by the report. Now, not everything is affected by a currency. Like we'll have on this report, crude oil inventories. We'll have natural gas inventories. We'll have G7 and G8 meetings on this report. Those don't necessarily affect the currency, so it'll either show nothing or say, for instance, the EIA inventory will show it's U.S. because it's the U.S. inventory of crude oil, but it won't show a currency. Now, coming down the left-hand column, coming down under currency, we can see two things. We'll see the currency that's affected and then the country. Because today with the Eurozone, we not only want to see the country that's affected, we not only want to see the currency, we want to know what country the data is coming from. After that, we go to column number 3. Column number 3 shows you the importance, the impact, the tier level, or the volatility. Different websites use different words, but they're all the same because all economic events are classified in 4 levels. The fourth level is on for non-market event, non-events, that's like a speech. It's like it's like I said, it's speeches. It is G7 meetings, G10 summits, because they don't particularly affect the currency. So these will be noted on the calendar, and a lot of them have nothing next to them, or some will have a nondescript volatility level. From there, we go to the 3 specific levels of data. Top tier data, which is called level 3 data, is very, very, very important data, which on its own can move the markets. In this calendar, we see for top tier data, important data, it shows us 3 bullheads. Some will have 3 stars. Some will have it by colors. Some will have 3 exclamation marks. You can always find the key somewhere on the calendar or the legend. It tells you what these are. So this one has 1 bullhead for low volatility, 2 bullheads for medium volatility, 3 bullheads for high volatility expected. Okay. And it's not really the volatility expected. The volatility only comes if those reports do not meet expectations. So it all comes down to is top tier data, very important data to the markets, can move the currency market. Level 2 data, which is important data, but does not necessarily move the markets. But like when we had the BBA mortgages, because housing is so important in the UK, even though it's a level 2 data, it had an effect on the pound. From there, we move over to the center. This is the event that's happening. Okay. Now, to explain all this to you, I'm going to take you over to a live calendar. So hold on, let me bring up that live calendar onto your screen. And as soon as it pops up there with us, I'm just waiting for it to come up on your screen. There we go. So this is actually today's economics calendar for the events for today. And so we can see my calendar is set in GMT time. It is today's calendar. And Actually, this is this week's calendar, so let's go over just to today's calendar. Let's click. I'm going to wait for that to pop up on your screen. There we go. Now, we can see the first event was at 0100 this morning. It was from China, and it was a level 3 event, and it was Chinese manufacturing PMI. Now, if you're new to the financial markets or you're new to the economics calendar, there are tons of events, and these events have all weird names. In the beginning, you're not going to know exactly what they are, and we understand that because every country sometimes names their events different. Like today in the U.S., we had the non-farms payroll report. Well, what does that tell you? This just sounds like for people that don't work on farms. Well, it kind of is, but it's the payroll, the important payroll report for the U.S. with the unemployment number, and we call it the non-farms payroll. In the UK, it's called claimant count. In the Eurozone, it's just called the unemployment report. So it's different for each country, different terms, but the reports are basically the same. But because we all can't figure out what all they are, especially when you're new, all the calendars will give you information. So some will have a little detail box. Others will have a hyperlink under the name. This one, when you have your mouse on the event, it lights up the whole line, and if you click on it, it's going to open up a box. And if you click under the description, it's going to describe this event. China Manufacturing Purchases Managers Index provides an early indication each month of economic activities in the Chinese manufacturing sector. It is compiled by the Chinese Federation of Logistics and Purchasing and the China Logistics Information Center based on data collected by the National. Okay, so it goes on and it explains it all to you. It tells you how it was collected by questionnaires, and the data presented here is compiled from the whatever, and it explains to you what it is. Okay, we also have a chart. So this chart details us back for the last 2 years, and we can see that 2 years ago, this manufacturing report was fairly high. It fell down, and it's been slowly getting better, but it got better in 2013. It fell way down over the winter time, and now it's been slowly getting better. So we're expecting it to climb back upward and continue improving. Okay, and we can see an overall picture of how it's been traded. Then we can go over to history, and it will show us the last 6 months reports. We can see here the previous, the forecast, and the actual, and we can actually start to see how the range of this report, where it comes out at, where it usually is, what the variance is between it, how big of a range it moves in. Okay. So all of this is provided to you when you open the window. So don't worry if you don't know exactly what they are. It tells you. Okay. Now, from here, we go over to the right side of the calendar. We're going to move backwards now. Previous is the data that is automatically filled in every time this report is released. Because when this report is released, tomorrow the actual from this report becomes the previous. Because the previous is just whatever the number was at the last release. Okay. So today's release was a 51.7, and the previous was a 51.0. So this will replace the 51.7. So when we look at this previous, we know that the last report released a month ago for Chinese manufacturing PMI was at 51. Okay. And it's just known that. So in other words, the U.S. unemployment report, the U.S. unemployment claims report, which comes out every Thursday, when we see the number over here, is that report what it was last Thursday. When we have quarterly reports, is what that report was last quarter. So it's just giving you information about what was. There's no analysis in it. Now, the economics calendar also is not deciding or evaluating things based on the current economic situation. It is just a set of numbers. Okay. It's not evaluating whether the reports are good or bad. It's not evaluating whether the economy is good or bad. What we have is just a number, what last report was. From there, we go to the forecast. The forecast is ultimately important. The forecast tells you what the markets are expecting the report to be at the next or this coming release. Now, because the forecasts are so accurate that the markets actually adjust the price of the currencies and commodities ahead of time to the forecast. Now, these forecasts are done by surveys. The surveys are done by very high-end professional agencies who specialize in this market. The surveys are also done through trade professionals. They're not going out and standing in a shopping mall and asking everybody what they think of manufacturing. They're going into the manufacturing and talking to purchasing managers only, and some are done by basic large corporations, some are done by small corporations. So the Chinese PMI was all the big corporations, and it's 700 companies are surveyed. It's the same 700 companies that are surveyed every month. So the forecast is pretty accurate. Now we have previous and we have forecast. The forecast comes out about a week before the actual event is due to be released. And what this means is about on Sunday, you could sit down and take a look at all the events that are on the calendar for the following week. You can take a look at all the previous reports and all the forecasts, so you can start doing projections and analysis of what you think might happen. Now, the key to all this is, okay, what we're looking at is today's calendar, and everything has happened here already. Now, the first thing is I'm going to tell you how to read this, and then we're going to go look at next week's calendar so we can figure out how to trade it. So what we have is, let me just get these markings off the calendar. What we have here is the previous, and then we have the forecast. Okay. Today, at 1 o'clock this morning, the Chinese data came out. Now, the first thing is this data comes by RSS feeds, and it comes virtually immediately to you on these calendars as fast as it goes to a hedge fund manager, as fast as it goes to money managers. You get these feeds and you get the data immediately. When I started trading 40 years ago, you couldn't get this information, and they came by ticker tape. And you had to know somebody who worked in a big brokerage firm that had a ticker tape and get them to stop what they were doing and give you tell you what the data was. So you were calling them all day and night long and hoping you didn't piss off your friend. Okay, so it was difficult. Today, we get these immediately through these RSS feeds. So you get them sitting at home. You can get them on your mobile phone, on your tablet. You can get them anywhere instantaneously. Now, when I say that, it's slightly misleading. Okay. These come out, if they're government releases, they come to everybody at the same time. But a lot of these reports are done by private agencies that they own the actual report. Like PMI, most of the PMI around the world is owned by a company called Marquette. And they analyze and release the data. Now, none of this is done underhanded. There's no deception. Okay. It's known and it's printed on their websites. It's told to the world. If they are private reports and those private companies have subscribers, have members, they will release this data up to, some of them, if it's a Thomson Reuters report, up to 2 minutes before to their subscribers, and then they will release it by the feeds to everybody else around the world. But it is printed, it is not deceptive. Okay. The Marquette reports are released 1 minute before. Now, it has to be for binary options. Okay. We don't really care because we want to follow what the market reaction is to the report. So we get the report, they're already reacting. Now we just have to look at their reaction. Now we come to the actual. That the data is released as it comes out that day. Now, the first thing we need to know is how to read this data. Okay. There are many parts to this. The first is the number comes out here. If it comes out in green, it means it was better than the markets expected. That's a positive report. Okay, let me just put my cursor on. Okay, so actually if you hold your cursor right on that number, it's going to tell you it came out better than expected because the markets were expecting 51.4. It came out at 51.7. So that is much better for the markets. Okay, where we go to Australian PPI, which is Producers Price Index, which is like business inflation, they were expecting a 0.7% increase, and they got a minus 0.1% increase in the red. That means it was worse than expected. Okay. In China, we also had a secondary report, which is, if you notice, is almost similar to the top report. It's Chinese HSBC manufacturing PMI. It was expected at 52.0, and it came out at 51.7. Now, after you're trading for a while and read some of these, you'll understand what the difference is. And it's only really with the Chinese data. What happened was for so many years, the Chinese data was not reliable. They would change the figures. They would lie just to impress the world. So HSBC Bank started releasing its own survey of small to medium-sized companies that they had contacts with, and their number became the reliable number. So the world depended on the Chinese HSBC manufacturing PMI report to get a true sense of what was happening. Well, with time and China really entering the capital markets and reforming its economy, their figure now is pretty accurate. So the markets rely on both of these and give them equal credence, but the Chinese manufacturing official government surveys 700 of the top businesses, where you can see the HSBC report is mostly small and medium-sized businesses. Okay. And so there's a difference in the number because they report 430 purchasing managers compared to 700, and they don't have access to the largest manufacturing companies. But if you notice, we had two different expectations, but the report actually both came out at 51.7, except the small manufacturers, we were expecting a little bit better number. Okay. From there, we're going to go down, and we see today also, because the reason I'm showing you all of these today, because we're going to go look at these and see exactly what happened on the charts. We can see Spanish manufacturing PMI. It missed the mark. French did a little bit better. Now, what happens with manufacturing PMI in the Eurozone, they release all the individual countries, and then they release the overall Eurozone PMI, which is a combination of all of the manufacturing throughout Europe. So first we have Spanish, which missed expectation. French did a little bit better. Germany did terrible, which is very upsetting because Germany is the workhorse of the Eurozone. And then the Eurozone overall missed expectations. So that means manufacturing is not doing as well as we thought it would do. And it fell below where it was last month. Okay, now let's take a look real fast at how this affected the assets. Now, since we don't trade the Chinese renminbi or the Chinese yuan, and it's only traded in very small areas, but you can't trade non-binary options. What you have to know is the biggest effect you get out of China is a direct effect upon the Australian dollar, because Australia is its biggest trading partner, and almost all the ore and most of all the exports out of Australia go to China. So when we look at the Chinese data, we will look at it. It gives us an overall feeling of how the markets are doing, but it weighs down first the Australian currency, then the New Zealand currency, and then the third is classified as commodity currency is the Canadian currency. From there, but we're going to try to go straight forward, because what we're going to look at right now for class is we're going to look at a very easy one to take a look at. We're going to look at manufacturing PMI for the Eurozone. Now, if you notice, this was released 7:15, 7:50, 7:55, 8 o'clock. So this all went on from 7 to 8 o'clock GMT time this morning. Okay. Now, what do you expect happened to the euro when this data was being released? So let's go up. I have a chart of the euro up here. Let me get my markings off of here for you. And let's take a look at 11 o'clock this morning, okay, when this data started hitting the wires. Now, my calendar on my website is not GMT time at the moment because I am traveling, and so it's at 1927, so it's 2 hours off. So we've got to go back to from 11 to 12 to 1 o'clock. So we want to go up here to 1300 and look at what happened with that data as it was being released today. The euro plunged straight down. Oh, I'm sorry, I'm on the wrong day here. This is the 1st of August. Let's get that off the wrong place. And let's get over here to today. And let's go see where the euro was. It didn't plunge as hard, but it did plunge. Hold on a minute. Let me turn off my marker here. Let's find it at, there we go. We can see as the data started being released, the euro came straight down. Okay, it reacts almost immediately. Now that was a wide range because it went from 07 to 0800. So from 11 o'clock on my chart time, straight down, we can see that the euro went straight down. Now, because there are all kinds of things that influence the market, this would give you a trade when this release came out. It won't give you a trade 2 hours later because the markets adjust, they react. There's constant flow of stuff. So the nice thing about the economics calendar is we can learn to set things up, review them ahead of time, sit down on Sunday, write all of our trading rules, write what we think is going to happen, what the forecast is, to decide whether we're going to think it's going to, what levels will be market negative, market positive, market neutral, and what we think the asset will do if the report misses forecast or exceeds forecast. And all we have to do is sneak out for a cup of coffee at work, pull up the platform on your mobile device, pull up the economics counter on your mobile device. When that number hits the wire, go make your trade and go back to work. Okay. Now, I'm going to teach you how to set all this up in a minute, but first we're learning how to read the economics. So from there, let's go over and we're going to show you that this really holds true all the time. So let's go look at what else happened today. Okay. Later today, we went back to 3-star events. We had 2 very, very important events in the U.S. We had the U.S. non-farms payroll report, which gives us the non-farms payroll jobs created, and we give us the unemployment level. This one report that comes out together. Now, we had expected 233,000 jobs. Okay. We got 209,000 jobs. Horrible, horrible report. We expected unemployment to stay at 6.1%. Unemployment climbed to 6.2%. Now, with the U.S., that's not a significant number because the mathematical calculations coming with unemployment have a way of shifting 1/10 of a point and readjusting next month. It's just a matter of a statistical anomaly. But the markets don't make a major reaction to that. But that, combined with the 209,000 jobs missing by 24,000 jobs, is a significant weight on the U.S. dollar. So what would we have expected when this report came out at 12:30 today? We would have expected the dollar to die and the euro to skyrocket. Okay. Or what happens when the dollar falls, the euro climbs. So let's go back and look at the chart and look at what happened here. Okay. This is right when the report came out. Right here. Let me get my marker back on here. And look at this. Look at that. Now, I had a live trading event. We trade this live, but this was textbook classic. Okay. And this is what happens over and over and over again. So now we have to figure, now that we know this happens, we have to start building a strategy. Now, you can either trade from the economics counter or not. You should always be aware of the economics counter because no matter what strategy you're employing, what decision you're making, if an economic event's about to happen and you don't know it, it can mess up everything you are doing. Because look at this. If you were looking at the euro earlier today and watching it fall here and then watching it stay down, you might have thought the euro was going to go down the rest of the day, and it probably would have, except this report was so bad that it turned around and reversed everything you might have been trading. And if you didn't know this report was due out and you made your trade, you would have lost your money in the blink of an eye. Where when you look at the economics calendar, even if you're not using the economics calendar to trade from,
it would have given you an alert saying maybe you should enter the markets right now because something's about to change. It could support it one way or another, but something's about to happen. Now, let's talk about how to trade from the economics calendar, how to build a strategy. So let's go back over here to let me bring the economics calendar back up on our screen. Now, the first thing we want to do is we want to use filters. Now, like I explained to you, level 2 data can affect the markets, but it's level 3 that is the ultimately important data. Now, a lot of reports have sub-reports that are part of that report. So if you notice, like in PMI, that's all the reports, the individual countries' reports with huge amounts of data being released. And like I said, it takes about 15 or 20 minutes for them to release each one. It's only the headline data that we see here, and most of these countries are level 2. But if all the level 2 countries had negative, together, cumulatively, it weighed way down. Now, you see that German PMI was more important than the Eurozone PMI because Germany is the workhorse of the Eurozone. So over the last few months, Spanish, French, Portuguese, all the other countries' data. Now, the reason you're also seeing a lot of countries, their PMI report is considered level 1, and we don't even look at the level 1 reports here. So they're going through each country of the Eurozone. So the reason you don't see Portugal, you don't see Cyprus, because their PMI is level 1 data. So I've already just filtered it off of the report. So these are level 2 and level 3 data. You do the filters by just clicking on the filter button up here. So we could click in here and put Portugal, and let's go put Portugal. Portugal, how do you spell Portugal? And let's see, Cyprus. Okay, and let's pick another country in the Eurozone that I don't have clicked up here. Let's see. I'm just trying to remember who else is in the Eurozone. I should know them all off the top of my head. Let's take Greece. Okay, and we're going to add in level 1 data. And you see when we do that, the reports go on. Just today's reports are that long. But if we go up here to the PMI data, we can see in here that there was, there really wasn't. They only released the main countries today. Okay, but we can see there was tons and tons of data. So let's go back and filter this off of here. And by simply getting rid of the level 1, we've cleaned it up mostly. Now, remember, I was saying level 1 has very little effect in the markets. Level 2 cumulatively could have an effect, but only level 3 data has the volatility and the importance that it will move the markets precisely at that event. So when we're going to build a trading strategy, we only want to look at level 3 data, top tier data. Okay. And believe me, there's more than enough of it. So let's go up here to our filter, and we're going to get rid of tier 1 and tier 2 data, and we're going to only leave tier 3 data up here. So all of these reports we could have analyzed and traded and made trades from today. Now, what we have to do is we have to determine what we consider market neutral, market positive, and market negative. Because there are ranges around the forecasted price that won't have much of an effect on the markets and won't give you a trading scenario. Then there's the range that it pushes it better or worse than far enough that the traders react. Okay, and that's where we want to do is gauge their reaction, because we go from market neutral, okay, and build that range where we won't have, what we're saying is it won't give us a trading scenario. Then we build what we call market positive. That means the report will be good and strong enough that it will push the asset or push the currency up, and therefore will give us a trading scenario. We also go to market positive plus, which can be way, way, way above, or on the reverse side, we have market neutral plus, which is way, way, way off, like the U.S. non-farms payroll report today. Okay. And that gives us a better trading opportunity. Now, the thing I haven't told you also is there's another part of this release. If we go over to the previous column, on the right-hand side, we can see down here that non-farms payroll report has a green number in the previous, and we see a red dot, a yellow dot. If we put our mouse in the yellow dot, it says it was revised from 288,000, and the new number is 298,000. It means it was revised upwards by 10,000 jobs. Okay. This is called a revision. When the new report is being released, there are many, many, many times that the previous report is adjusted because all of this data is coming in. There's huge amounts of data and all kinds of calculations, and some reports come in late, some surveys come back late, some information comes in late, some companies or some people have to adjust it. There's errors made, and they spend the next month fixing all that, and when the report comes out this month, they will make an adjustment to the previous. So you have to remember that because an adjustment has to be calculated into the trading scenario of the report. So for instance, we're looking at the non-farms payroll report. We had a very significantly bad report. It was 209,000 jobs, a miss of 24,000 jobs, but we also had an upward revision of 10,000 jobs, okay, that were created last month. So say what happens is people actually started working, say, and were hired for these new jobs, and they actually didn't have their first payroll day to the 1st, but they were hired on the 31st, so they pushed the number back into last month's revision. Well, technically, you could add it on to this month's report. So instead of being so significantly bad at 233 to 209, we can say that it also has 10,000 new jobs added to it from a prior revision. So it came out at 219 technically or analytically, and therefore it was still a miss and a tradable miss, but it wasn't as significant of a miss as possible. You follow me? So you have to add and subtract some things from these numbers. Then, like I said, unemployment is part of the same report, and unemployment, when it ticks 0.1% in either direction, isn't a major catastrophe, or if it went down the other way, it wasn't a major event. Now, it supports the number up above. So in this case, we had the 209, which was a significant miss from the 233, and we had the revision upwards here. We had the 209 here, which helped make this less as bad. But then we had the drop or the climb in unemployment, which offset this. So we're back to a fairly weak report. You follow me? Everybody with me and understand? So what we have to do is we have to be able to build what we expect and then what we get. We do this by building what we call market neutral, market positive, and market negative. I'm sorry, let me just clean this up here. Okay. Now, to do this is I'm going to now bring up next week's reports, because we don't want reports that have already happened. We want reports that are about to happen, because you can't trade something after the fact. You have to be ready to trade it when it's released, and you have to analyze it before the release. Okay. Now, so let's go over, and I'm going to bring up another calendar for us. Just give me a second to get it up on your screen. And here I have, when it pops up in between, is, there we go. It's coming to you now. This is all the reports for next week. So first thing, let's go down and filter out the level 2 reports. That we only want the top tier data, or the data that will affect or that we can trade in the markets. Okay, so now we have all of these level 3 events. Okay, so it's enough to keep you trading all week long. The first thing is we want to take out interest rate decisions, because Interest rates have no, they are a whole different animal. Okay, because they're not economic, they're economic events, but they're not based on anybody's projection. We're waiting for, they are different. Those you'll learn how when you come to a class on trading central banks decisions, because those are just decisions. So we can take those reports out. So we can filter those reports out, and that's what we're going to do first. We're going to actually just remove them from the calendar. By going to filter, we're going to come down here, and we're going to remove central banks, and bam, now they're gone. Okay. Now we see all the major data. So what we're going to do is we can only take one event tonight. You can take the other events on your own, start learning about them, and that's why on the weekends you can spend 15 minutes on each event and read about them, learn about them. There's tons of information about them in the internet. So let's take the first event on Monday, which is retail sales in Australia. And that's a very important event. All over the world retail sales are, and every country releases retail sales. We can see it's a top tier event. It's coming out at 01:30 in the morning in GMT time from Australia. We can see that the previous was a minus 0.5, so retail sales had fallen last month. This month we're expecting a climb of 0.4%. So let's click here and open the window. First, let's go to the description column and read retail sales measures the change in the total value of inflation-adjusted sales at the retail level. It is the foremost indicator of consumer spending, which accounts for the majority of the overall activity. Now, if retail sales are good, it means consumer confidence is good. If consumer confidence is good, it will propel the job. And what it means is if people are happy, their jobs are secure, their wages are going up, they're spending money. If they're spending money, the whole cycle is working around. If we don't have consumer confidence, it stops somewhere and the cycle doesn't move forward. So consumer confidence is very, very important, and we can judge that based on retail sales. So it's an important report and will have a direct effect on the currency. Now, let's go see what happened here. We can see that retail sales were steadily moving upward for the last year, and then it looks like about March, they came crashing down, and they've been falling ever since. So it's weighing very heavily on the Australian dollar. And this report will be very significant if it reverses the course and starts climbing back up. We can see if we put a line across here that the overall, this is somewhere about the average. So we have about a 0.5% increase on a regular basis. So this gives us some understanding of what to expect, because this is what we have to know in order to build the market negative, market neutral, market positive, because we have to then start figuring out where we can expect this range to be. Now, from there, we also have to see how this report comes out. Does it move in 0.15, or is it only in whole numbers, or only in 0.10? And what is the range that it actually moves in, and what's the variance that it usually has from from forecast to actual? So we can see here now that this report, and that's the thing about retail, it can jump several tenths of a percent, but it only moves in 0.1%, and it's a very, very, very tight range. So this tells us that when we build our market neutral territory, we're not going to have much of a range. So this tells us right off the bat it's going to be a very, very small range. So what we're going to say is that if this report comes out at 0.4%, that is market neutral and it will not be tradable. Okay. If it comes out at 0.3% or lower, it will be a market negative, and we will see the Australian dollar go down. If it comes out at 0.5%, we will see the Australian dollar go up. But if it comes over at 0.6% or higher, that's going to give us a market positive plus. If it comes below 0.2%, it's going to give us a market negative minus. Okay. Now, the difference is when you go into market negative, you will most likely get a nice 15-minute trade going in the direction that if it's market positive, up, if it's market negative, going down. If it comes over into the market negative territory, market negative plus territory, or the market positive plus territory, you will also get a 60-second trade because the markets are going to have a very harsh immediate reaction. If it comes over to market negative plus or market positive plus, you can get a 60-second trade in, but then you want to sit tight because what's going to happen is you're going to have this immediate reaction, and it's going to push the currency in a very significant way past where it should be trading, either up or down. Then you have to wait a minute or two more and let the markets adjust. When you see the markets adjust, and what you have is a three-part scenario. You have an immediate reaction, you have an adjustment, and then you have the correction. Once you see it go either up or down significantly, and that's only when it's in the market neutral plus or the market negative plus, you will adjust. You can get the 60-second trade in. Then the markets will adjust and they will come down or go up a significant amount, and then they'll start the correction. When you see it reverse and then reverse again, that's when you can get in your 15-minute trade in the original direction which you had ascertained. Now, if it just comes in market neutral or market positive without going over to the plus territories, you can just make your trade off of there. It's just when you come out in far variances, there is a very harsh reaction in the market. You have to wait for that harsh reaction to go away and get adjusted to get in there and get that 15-minute trade. Because a lot of times it's moving so quickly by the time you enter your fingers to get the trade, it's already way past where it's going to adjust back to. So that's why you can set up ahead of time and be ready to trade that 60-second trade so you can hit that button really quickly because it is cascading up. Just like you see today with the euro, the US dollar, when the non-farms payroll came out, this cascaded all the way up. But now today, because the report was so bad and there were so many factors, it didn't even make an adjustment. Now what we see is right now we are getting an adjustment. And it's coming back down, and it will probably still pace down a little bit because it's way too significantly high at the moment. Okay. So you have to be able to decide market plus, market negative, and decide how you're going to react. And that's why you will sit down ahead of time and build your trading plan, and you will actually build these territories and decide at what points you will act and what points you'll react and how far you will set them up. So you build your market neutral. Market neutral means no trading. Market positive and market negative say 15-minute trades. Market negative plus says a 60-second trade, wait for the correction and then trade it. Market negative plus says the same thing. Now, there are times that you have a disastrous report, which is what we had today with the non-farm. And you can say if it is so low, or so high that it's just going to give us, let's get in, and it can be so erratic that you can say, I'm just going to take a 15-minute trade and stay away from the 60-second trade. Or you can get a 60-second trade backed up with a 15-minute trade. Okay. Either one you can do, but you have to build these territories. So what you do is you build these territories on Sunday when you have time to sit down and look at the calendar for the week. Build them for all of the assets. Okay. Analyze them all, spend your time building your territories, and then all you have to do is, you know that this report is coming out at such and such a time. Get your mobile set up or get your PC on. If you're sitting at your desk and working, get it up on your PC and make sure when you're talking on that phone conference, you just look up and see what that report is, see what the report is, click your buy or your sell button on that asset on the trading platform, and just continue with your work for the day. It is that simple. Now, this is the first in this class for option trade. We will be teaching this class again, I think, in 2 more weeks. When I do, we will pick up a little farther down. Each class we will get a little bit farther forward. So this class has also been recorded. In a few days, it will be available to repeat and watch. But you have to practice building these market neutral, market negative, market positive territories. You have to also go back and just go. The nice thing about trading the economic, you don't have to actually make these trades yet. You can go on the platform, watch the results, you can go back, a day after the events and go back and look and see what the events came out, where they would have been in your strategy, and what the markets actually did and how the reaction was. Okay, so you can practice all this over and over again. Try it many times before you're ready to invest your money. Then when you figured out how to build these territories, write them on a piece of paper. Sit down and write your whole week's worth of trading and figure out what you do for all of these events, and then be ready to trade them and practice for a week. Practice for 2 weeks. And then when you've got them all down right, because it is a little bit of personalization when you're figuring out what these territories are. But you want to figure out far enough that they're safe so you get the right trades in. Okay, and on that note, I'm going to say goodnight to everybody. Wish you a great beginning of August, and hopefully I will see you in another class soon. You have a wonderful night now, and take care. Bye.